Hey traders, Jason here from Levitt Brothers. So let's talk about the state of the market. Market's been on a nice run since bottoming last October, November. It was up for several months in a row, took a month off. Now it's up another 2 months in a row. Overall, things looking good. Breadth, on the other hand, has been weak. Okay, a lot of people on Twitter, other social media have noted the negative divergences with the indexes going up and breadth being somewhat weak. I've been one of them, but I've done it in both video and in report form. So let's circle the wagons, take a big deep breath, and see what's going on. All right, so we're going to look at the index charts, and then we're going to look at some breadth reasons and just get an idea. All right, so here's the S&P 500. Charts don't get much better than this. This is the monthly chart going back about 8 years. You can see nice uptrend in 2017. We had a bear market at the end of 2018. Another nice move up into 2019. Huge disruption for COVID in early 2020. But then we had like a 21 month rally in 2020 and 2021. Then you can see this 2-year cup and handle pattern forming. S&P breaks out, goes up 5 months in a row, pulls back 1 month here, and now it's up 2 more months in a row. Numerous months in a row numerous months in a row since the bottom. The market has hit an all-time high, closed at an all-time high. Everything looks great. If you want to do like chart pattern measurements, this measures up to like 5,700. There's another measuring technique you can use that I favored that measures up to 6,000. That's my target. Okay, you get a nice run here, cup handle breaks out, everything looks great. 6,000 is just a big fat whole number. It's going to be a magnet. I think even if we do have some sort of dip this fall, I think 6,000 is going to happen at some point in time. Several months ago, people probably would have laughed at me by saying that, but with the S&P already up at like 5,500, 6,000 is only like not even 10%. So that's not even that much. So overall, this looks really, really good. The big drag on the market is the Russell 2000. This is IWM, the ETF. You can see in 2021, a big consolidation pattern. Then 2022 and 2023, we have a consolidation pattern at a lower level. And now in 2024, we have another consolidation pattern, this time at a slightly higher level. So on one hand, this is lagging the S&P. Obviously, everyone's noted that big divergence between large caps and small caps. If I wanted to spin this to be not as bad as it seems, it's that we're actually only like 10% away from a high. Okay, so if you look at, say, this run here, or this run here, or this run here, if we get just a similar run here, we can go from IWM's here, which means it's unchanged going back to late 2020, early 2021. Yet if we just go on a little run here for a couple months, 10%, we're at an all-time high. So yes, it's lagged, but we can print an all-time high pretty quickly. All right, here's the S&P 500 daily going back to the low from last year. As you can see, steady uptrend, pull back here, move up, pull back here, little consolidation pattern, a little consolidation pattern, a little consolidation pattern. Printed a new high there and then fell back into the pattern, and then today it's up a little bit, maybe flat. So this looks fantastic. Okay, if I got what I wanted, I'd get another one of these. Give me a couple weeks pull back, shake the tree a little bit, let the leaders separate themselves from the laggards. And then get another run after that. I don't like how we have like teeny tiny pattern, small pattern. These kind of small patterns kind of build pressure, and that pressure can be released to the downside. So I'd prefer to get a nice pullback. I don't know if it'll happen eventually. The market's not going to just keep doing this, but anyways, overall, really, really good. When you look at like that, up, down, up, I don't know how you can be anything but long. You can't really. Yes, we're going to get a pullback, but I'm not going to play it. I'll just step aside and then I'll start building my list for the next move up. I find that when I want to go short, then I start rooting for the short side and then I miss the turn. So S&P daily looks fantastic. NASDAQ looks equally good, moved up here, sideways, breaks out here, comes back down to test, moves up, and then into consolidation mode for the last 2 weeks. Printed an all-time high on Friday, closed back in its range. Today, it's down a little bit, but whatever. It could do some more backing and filling. It could fatten up. It could have a bigger consolidation pattern. Whatever happens, the market is strong. It's healthy. It's moving up. Everything looks great, and we're more likely to continue up in the long run than top and have a significant pullback. July tends to be a very good month for the market. August and September are traditionally not good months for the market. So maybe we got some more upside, and then we'll have, as the kids go back to school, maybe we'll get a pullback, and then we'll get a great run at the end of the year. Whatever path we follow, I'm pretty confident at the end of the year we're going to be, higher. All right, let's look at some breadth readings. Here's the here's the S&P 500 versus the NYSE AD line. They match up pretty well, which is why divergences are significant. So you see a high in the market here, a high in the indicator, low in the market, low of the indicator, high of the market, high of the indicator. Okay, and then the problem is we have a high of the indicator here, high of the market, but then, and we did get a little bit of a pullback here, but then this pressed forward and this moved down. Okay, so there's your divergence. We had a high here, and it matches up over here, and what we got is we got sideways movement. And the same thing has happened numerous times. We either get it, when the indicator turns, the market turns, or at the very least we get one of these sideways patterns for a week or two. But that hasn't happened recently, where this topped and started trending down, and this topped, rested for a week, and then started pressing up. Okay, that's one of the big divergences that's been noted on social media. I've done the same thing. We all have access to the same information. So the bad news is the advanced decline line over the last month and a half has been flat. So advancers and decliners have been equal, but the market has moved up, which would suggest that the bigger, more powerful, heavily weighted companies are doing well, but a lot more smaller companies are falling off. It could last in the near term, but it needs to right itself. Now, the good news is, that's the bad news, that there's the divergences in place. The good news is this has just simply been flat for the last month, and it really wouldn't take much to just do this, make a higher high, and confirm the price action here. So even though there's a divergence in place, it's not a super strong divergence. So it's not... It's notable, okay? We got to stay along in the best charts, but I don't think it's something to panic about. I definitely want this to, if you're long, you want it to resolve up and negate the divergence. All right, here's the S&P 500 versus Russell 3000 stocks above their 20-day moving average. So, when the market's doing really well, you get these prints up here. When the market continues to trend up, but it's starting to weaken, you get these oscillations at a slightly lower level. And so what we've gotten here over the last month or so is prints at a pretty low level, but we got a breakout a couple weeks ago, came down and tested, and then closed at a higher high. 51% is where it closed, so more than half of stocks were above the 20-day moving average. It's not fantastic considering what's been going on over here, but it certainly is less bad than what it's been. So I'm slightly encouraged. Okay, I'm slightly encouraged that it dipped, it consolidated. A lot of stocks were above their 20s, but then we got a breakout, a test, and a reassertion of the mini uptrend. And so even if you're not super encouraged by this, it's certainly less bad than it's been, and that's a good sign. It's a move in the right direction. Next chart is S&P 500 versus Russell 3000 stocks above their 50-day moving average. Similar type of situation, okay? Market's doing great. We get a lot of prints above, up here. As the market starts to weaken, we get prints at a lower level. Recently, we've been getting prints. You can draw the trend line in several different ways depending on how you want to capture this. But bottom line is, less and less stocks were trading above their 50, but in the last couple of weeks, we got to move up to match the high, okay, like right there, then a test down, and then a higher high there. So it's not great. It's not as good as it should be considering how much the market is up here, but it's less bad in its position to break out and go on a little bit of a run here if it wanted to. Okay, so that's kind of the message here, is that it's been bad. We have divergences in place, but it's less bad than it's been. All right, here's the SP versus the this is the 2 moving average of the 5-day high low. You can see, market in an uptrend, we get prints above 0. Market starting to weaken, we start getting prints below 0, oscillations below 0. So recently, over the last month, we've had all these prints that are mostly below 0. But as of Friday, this closed not well above 0, but it closed near, a 1 month high and ready to break out and run. Okay, so it's less bad than it's been. We should be getting higher prints. The complete lack of prints up here is concerning, but at least the indicator is at a 1 month high and is ready to move up. So it's less bad than it's been. It's nicely positioned to go on a run if it wanted to. Here's SP 500 versus the 1 month high low. Similar situation here. For the last month, we've had prints below 0. Friday closed above 0. It's positioned to break out and run if it wanted to. There's a 3 month high low, similarly positioned. It has been declining. That's a divergence that we've noted. Okay, more stocks making 3 month lows than 3 month highs, but it is less bad than it's been, and it's positioned to break out and run if it wanted to. And then last one is the 52-week high low, which is similar to the 3 month. Same thing. For 4 to 6 weeks, we have more stocks making 52-week lows than 52-week highs, which makes no sense whatsoever considering the market is, it's like what, 9 months removed from its low. The index have printed numerous all-time highs going back, several weeks. It's like almost every other day it's like a new all-time high, and yet number of stocks trading above trading at a 52-week high versus 52 low has been declining. But it too, in the last couple weeks, is less bad than it's been, and it's positioned to break out and run if it wanted to. All right, so overall, indexes are in really good shape. NASDAQ, S&P doing great, lots of all-time highs. Divergences with the internals have been noted several times in videos, in reports, in charts posted on social media. Everyone knows about them. Everyone has access to the same information. They are there. But the development that I see having formed in the last few weeks is that they're less bad than they've been, okay? And they're positioned to bust out and go on a run here if they wanted to, okay? They're not at their lows. They're kind of more middle of the range at previous highs, and just give it a little nudge. These things could break out and run if they wanted to. Okay, July tends to be pretty good. August, September tends to be pretty bad. Things could get disrupted with the election, but right now bias remains to the upside. And that's it for now. If these divergences resolve up, then market should be able to go on a little bit of a run here. If they don't, then the market's probably going to be a little bit more choppy, and we have to continue being good stock pickers rather than a spray and pray type of approach, because right now a rising tide is not raising all ships. All right, we'll see you next time.